Well, hello, everyone. My name is Joshua Kagan, and I'm the co-founder and CEO of Bonfire. And welcome to Liquidity in Real Estate, why you need to understand tokenization now. The goals for this webinar are for you to come away with a better understanding of how blockchain and tokenization will likely impact real estate in the coming years and how it might affect your existing or future portfolio. Note that this webinar is geared for the blockchain curious crowd, and not for people who either have a PhD in cryptography or people who, like Warren Buffett, think that crypto is the scum of the earth. I sense most of us live in the middle anyways, and that's who this content was crafted for. And today's agenda will consist of a high-level explanation of what blockchain and tokenization are, why tokenization matters, some real-world use cases, and how to achieve wide-scale liquidity in real estate, and hopefully leave ample time for Q&A. So let's kick off. And if people have questions, I should also say, please type them in the chat below. So as mentioned, I'm Joshua Kagan, co-founder and CEO of Bonfire. I've spent the last 14 years at the nexus of real estate, finance, and sustainability. I began my career working at a venture capital firm called Atlas Capital, where I focused on energy efficiency, smart grid, Internet of Things, all related to buildings. Then Richard Branson and Al Gore had dinner. Branson got really freaked out about climate change, wanted to do something about it, and created a company called the Carbon War Room, and asked the managing partner of our fund to come over and be the COO. And he asked me to come over and run the energy efficiency and buildings division, where we were focused on investing in efficiency projects in multifamily office and hotels. Did that for 4.5 years, and we got acquired. And then I went to a startup called Klein Fund. I joined as managing director. It's a specialty finance company out of Sausalito that provides capital for energy efficiency projects using a structure called PACE, Property Assessed Clean Energy. It's a way for borrowers to source capital that they otherwise wouldn't have access to and reduce the carbon emissions from a building while also executing a project very profitably. Clean Fund grew when I was there from 1.8 million to 94 million in recurring revenue in the first 144A securitization in industry history. In the meantime, I also, in 2011, I started doing my own real estate projects. I bought a foreclosure in the Berkeley Hills. I fixed it. I was the GC on it. I leased it up. I had no idea what I was doing. And then started doing more foreclosures and fix and flips, and then built out a rental portfolio doing the BRRRR method of buy, rehab, rent, refinance. And then left Clean Fund to start Bonfire. Bonfire was born out of conversations that my co-founder Vi Gupta and I had with our friends, many of whom are in their 30s and 40s, who want to own real estate but lack the have the student debts and don't have the ability to source the down payment, or because interest rates have doubled in the last year, have the financial qualifications to be able to own real estate and get on that property ownership ladder. Just a very high level about Bonfire. We're a platform. It's a very simple model. Someone has a real estate project. They could be a developer. They could be a sponsor. We validate the project. We make sure that, if it's an existing asset, property tax has been paid, title's clear. If it's a new project, we really look into the sponsor's background and the specifics of the deal. Once we're comfortable with it, we tokenize it, meaning we chop it up into little pieces known as tokens, and then we sell them to a group of investors that could be domestic, international, accredited, unaccredited, and each member's interest is recorded on the blockchain, and we go into a lot of detail about what that means later, and in theory could be traded in a liquid manner in the future. And as I said, I will go into more detail later. But today I'm joined by a luminary in the real estate field. Saul Klein, I call him Better Call Saul, is consistently ranked as one of the 100 most influential people by Inman. He was the former CEO of Point2 Homes that was acquired by Yardi. He was on the founding team that built Realtor.com, former CEO of the San Diego MLS, and is currently the founder of the Data Advocate. He's an author, speaker, and a general savant when it comes to all things related to real estate. And we're genuinely lucky and grateful to have him today. And he will kick off with some opening remarks.
Joshua, thank you. It's great to be here, and it's great to be able to talk about my passion, which is real estate, and has been real estate since I was a kid. Since my parents started buying real estate every time we moved. My dad was in the military, and I think everybody should own real estate. And I've thought this for many years. And so, to kind of get as a preface to what you're going to talk about, I want to talk about some basic things that a lot of people know about, but I think it's always good to go over and to kind of brush up on. And that is, why is real estate such a great investment? We all hear this continually. First of all, it's a great wealth building tool, and it is the wealth building tool. So to be able to pass wealth generationally through real estate is something everybody should consider and everybody should be looking at. And real estate is a secure investment. We say in the real estate world, under all is the land. Basically, the land is needed for everything, and there's a use for it. And so being able to invest in that is a pretty secure and safe asset, provided you do it properly. And so everyone should acquire it. And if you can't buy it, you should figure out a way to buy it. A lot of times you can't buy it on your own for reasons of capital or capital requirements, or the fact that you might need the money later, liquidity. And so is there still a way to be able to buy that? So next slide, please. We talk a little bit about ways in which you can buy real estate. So first, you can go out and buy it by yourself. And the first thing people should do is look at a way to buy real estate on their own. If you can buy a house, buy a house. If you can't buy a house with someone else. That's the way I bought my first house. I found someone who would buy that house with me. And then there are many other ways, a number of other ways to buy it with other people. So consider buying it with other people. Buy it with friends, buy it with family. You can get involved in different types of partnerships, general partnerships, limited partnerships, limited liability companies, corporations, be they S corporations or C corporations. Each have their advantages and disadvantages, which we can talk about in the Bonfire community or take questions later about. But there are ways to get into real estate. There have been traditionally for a long time, and to continue to look at those. But we're seeing with you, Joshua, new ways to do this. Next slide. So I like to tell people real estate's the ideal investment. Ideal. What are the things that you can pull from real estate? Number one, income. Based on how you buy it, it's an income producing asset, or it can be an income producing asset. The next one is depreciation, that you get a certain, not the fact that it wears out, not actual depreciation, but theoretical depreciation, which is a non-cash expenditure, which will reduce the tax burden on the income that you receive. And then the next one is that you get what we refer to as equity buildup. And so if you finance your property, you make your monthly payments, and a part of that monthly payment is interest, but a part of that is equity. So it pays off the loan. It reduces the principal. So that equity buildup, just through long-term making those payments, is going to increase your equity in the property. The next one is appreciation. We know this particularly in the last couple of years, that real estate has appreciated dramatically. As a matter of fact, it's appreciated too much in some areas, and it's probably going to drop in some areas. That's going to create opportunities for people. So appreciation is a great benefit. And then the last one is, there's nowhere else can you get the leverage that you can get when you buy real estate. The ability to borrow money, other people's money, to buy this asset that's going to go up in value, that gives you tax advantages, that creates income. And so that's why I say real estate is the ideal investment, and everybody should be looking at ways to invest in real estate. Again, we know that there are these restrictions. Number one is that you might need some of your money for later, liquidity, and that real estate's marketable, but it's not readily liquid. All right. So you can't, typically in a moment's notice, turn that real estate into cash, but maybe you will be at some point in the future. And then there are certain requirements to get involved in some of these different types of investments. You have to have a certain amount of money to invest in some of these group investments, and that's going to change. There are also the side advantages we talk about, which is the next slide. And that is the capital gains treatment, the fact that you get preferential tax treatment when you sell the asset. And like all assets do, if you hold it till you die, your heirs get stepped up basis. And that's a great benefit. So you get this bonus tax treatment. Also, something that we refer to as Internal Revenue Code Section 1031 or 1031 tax deferred exchanges, where you can build your estate with pre-tax dollars. And that's a great advantage in real estate. So why real estate? Lots of reasons. Next slide, please. different ways to buy real estate, different strategies. And a lot of times people think that buy and flip is the way to do it. Personally, I'm a buy and hold type of person. That's always been my philosophy. I had a client early on who bought real estate, and her philosophy was buy real estate, never sell it. And that was always tough for me because she'd give me an equity in the property when I would find real estate for her, but she never had any desire to sell her assets. So you can buy and flip, buy and sell, or you can buy and hold. There are also phases. Next slide. There are phases when you buy real estate. We kind of go through that. You go through an acquisition phase, a holding phase, and a disposition phase. So things that you have to be aware of. You have to acquire it, then you have to manage it, and then you have to figure out ways to dispose of it. So that's kind of like real estate in a nutshell, why real estate is a good investment. And I'm anxious to hear, Joshua, what you have to say about fractionalization, because when I first heard about what you're doing at Bonfire, I kept thinking, and it's a small example, but instead of buying my Starbucks coffee today, maybe I can invest it in a chunk of real estate. Or maybe it'll take 3 of those cups of coffee that I would buy at Starbucks. But now I can buy real estate maybe with other people without the same types of requirements. At some point, it might be more liquid. And what makes that possible, I think, is the technologies you're going to talk about.
Thank you so much, Saul. I think folks on the call can see why we call him the professor. I mean, in 4 minutes, what he was able to cover, is pretty extraordinary. Imagine him for an hour, and just so much information and a treasure trove. So thank you, Saul, for that. In order to sort of dive into liquidity and the benefits of tokenization, I think it's really helpful if we all get on the same page about what we mean by these terms. Because oftentimes I hear colloquially, people will conflate these terms. And I just want to kind of level set, not that these are the only definitions of these things, but kind of a working definition for today. So the way that I think about blockchain is as a decentralized database that basically stores information on a digital ledger. And, each block of data is built upon each other in a series of chains. That's why it's a blockchain. But the innovation here, is that because of cryptography, these chains of blocks or blocks of chains are basically computationally impossible to reverse. So that ensures that the data found on each block is secure and immutable, right? That's the big innovation that we're talking about here of why blockchain. Crypto, on the other hand, is a digital or a virtual currency that uses blockchain to facilitate secure and anonymous transactions. So think of blockchain as like an operating system of a computer. In my case, I'm on a Mac and I'm using, operating system Big Sur. And think of crypto as Safari browser. It's an application layer built on top of the operating system. So blockchain can exist without crypto, but crypto can't exist without blockchain. Now, real estate tokenization, what is that? It's the process of fractionalizing or breaking down property into tokens stored on a blockchain. And investors can secure direct ownership in a piece of the underlying tangible asset without buying or managing the asset themselves. These tokens can be traded and transferred like any other digital asset, but their value is derived from the underlying asset or the value that it represents. So why does tokenization matter? Like, why is this a game changer? I think that there's a number of benefits. If you can legally buy and sell interests in real estate via decentralized blockchain, you're immediately reducing the middlemen associated with most real estate transactions, right? Signatories, notarization, submissions, approvals, county assessors, right? So that friction of intermediaries is going to reduce third-party costs significantly, while also rapidly accelerating the amount of time it takes to settle. From days to, the blockchain that we use, Polygon, is literally seconds, right? That's a huge benefit. Another one is that tokenization reduces ticket sizes from $100,000 to $100, right? And this is going to enable foreign investors and larger numbers of small investors to come together and invest in real estate in a way that they haven't before. So I almost look at like this is a new form of capital in the capital stack that will be emerging. And also, a problem that Bonfire and tokenization in general solves for me personally and my co-founder Vi is, we have a portfolio, each of us, of single-family rentals and various rental properties, but we're constrained to the geographies we live in, right? It's hard to manage a property 3,000 miles away. But again, with tokenization, we can own properties all over, still own and have all the tax benefits that Saul referenced, while not having to actively manage them, and be, have it be in my backyard. It can be more geographically dispersed. Tokenization facilitates direct ownership and all the tax benefits associated with it, which is different than a REIT or other kind of investment structure where you're investing in a corporation that owns a pool of securities, but you don't actually own any direct real estate. And last, as Saul referenced, there's the potential for liquidity, and I'm going to go into more detail on that later. So the next thing I want to discuss is how it actually works. How do you legally tokenize an asset? It begins with really determining what the structure of the asset you want to tokenize. Is it a fund? Is it a REIT? Is it an individual special purpose vehicle like an LLC? In the case of Bonfire, we create a Delaware series limited liability company, LLC, for our US-based assets. Each LLC in the series is treated as its own separate entity. Ownership is tokenized into specific, this is called, the token that we use is called ERC20. It's the kind of most standard industry protocol out there. It's built off the Ethereum protocol, but we use the Polygon blockchain. Individuals retain full rights to the property held in the LLC, so that's not any different. And where I guess we're a little bit different than some entities out there is each of our tokens has a smart contract embedded, actually 7 of them, embedded in it with metadata that's constantly updated related to details on the property. So you can look on our tokens and you can see what's the occupancy, what's the rents, what's the submarket looking like, supply. All these things are embedded within the token. So that's how, on a very high level, what tokenization means. Now, if you're conducting a tokenization offering, this is more for sponsors and issuers on this call. You'd first want to determine, what kind of securities you're offering, because for better or worse, tokenizing projects will fall under securities regulations. And for folks who say that, the securities rules of the last 100 years don't apply to something because it's blockchain or crypto, I would steer away from those folks, because that's a very aggressive and untested perspective that unfortunately we've seen some actors in the market take. So the most straightforward way to conduct a tokenization sale is under Reg D, where it's an exemption under the SEC, where only accredited investors can participate. Although there's an exemption called Reg CF. CF stands for crowdfunding, that allows non-accredited people to participate. Unfortunately, the legislation around Reg CF is pretty poorly written, and it makes it very difficult for non-accredited investors to invest, but it can still happen. Each investor will be subject to KYC, know your customer, and anti-money laundering rules. And based upon the securities exemption you're filing for, will determine whether you need to do things like a private placement memorandum and what kind of ongoing filing you need to do. So what are some real world applications of tokenization? Well, there's a number of them. One of the ones that we're seeing a lot of potential deal flow around is developer equity. Developers raising JV equity or LP equity, and basically tapping into a global pool of smaller investors. We're seeing demand for repositioning, and I'll reference a project in a minute that we're working on right now, where someone's doing a value add play, and again, this is a different source of capital than than sponsors have historically had access to. If they're disposing an asset, when Bonfire did our minimum viable product, our proof of concept last year, a seller sold a single family rental to our group of buyers who came together to own the single family rental. There's also a use case of a partial sale of an asset. And this is really interesting too. Like imagine, you're in a house right now and across the street, grandma has had her house for 40 years and owns it free and clear and needs, $100,000 because she wants to pay for her granddaughter's college education. Well, it's probably more expensive than that. Doesn't want to incur a HELOC or a second line home equity line of credit or debt. Well, we could tokenize her asset and enable people to buy 1/10 of the house or a quarter of it and give her, cash without her incurring debt. That's a really interesting use case. So as I referenced, we did a proof of concept. Bonfire did a proof of concept at the end of last year. I'll just kind of briefly touch on it. $310,000 asset. We turned into 10,000 tokens. 160 people bought from 15 countries. Took 10 days to sell. It was zero word of mouth. But the thing that was so remarkable from this experience, from my vantage point as a co-founder, was the number of people who came forward on our Discord or Twitter and said things like, I'm an economist in Argentina and I now own real estate in the US of A, or I'm a cab driver in Jaipur, or I'm an American and I never thought I'd own real estate, but I now own real estate. And it's just a very powerful experience to see, although we're in like the top of the first inning of it's like the internet in 1995 or 6, like getting a flavor of the impact that this technology will have on people. The next asset in our pipeline, we're jumping a little bit from a 310,000 single family rental to a pretty large hotel in the San Francisco Bay Area. It's the sponsor is I would say an A+ sponsor who's done 145 deals, 2.5 billion of real estate under management. And historically, there's $100,000 minimum to get into a deal like this. It's looking at like a 27 to 29% IRR. And with tokenization, we're going to enable people to come in at a minimum of, let's say, $1,000. And, everyday folks, and I include myself in this, don't usually have access to these kind of deals. And that's the power of tokenization. And so we're super, super excited. This is going to drop in the coming weeks. Yeah. And so next thing I wanted to talk about is how is liquidity actually achieved? Because it is our vision that in the future, it will be as easy to buy real estate as it is stocks. But in order for that to be achieved, there's a number of conditions that need to be met. And one of them is trust. And trust from the buyers of the tokens that the token that they're buying actually represents a legal, a actual vested ownership into an asset, right? So we need to have standardization around how tokens are represented. We also need homogeneity. And what do I mean by that? If any of us go on Charles Schwab or E-Trade or whatever, and we go buy Tesla or Amazon or Apple, they're all subject to, NASDAQ rules of compliance, which mean that there's, filing S1s and 10Ks and all these documentation that shows financials, a balance sheet, and all these things, right? Well, we're going to need to do a similar thing for real estate. We're going to need to show that when someone's looking at an asset, whether it's an office in Manhattan or it's a multifamily in San Diego, that they understand that the data is consistent in terms of occupancy, asset level data around occupancy, deferred maintenance, all those various aspects, as well as the submarket data. How much supply is coming online? What's the vacancy rate like in the market? What are the comps? is there an appraisal, right? All that has to be homogeneous. Otherwise, we're never going to attract institutional investors, because it's just going to be a bunch of apples and oranges and pears, right? So we have to make it apples to apples. We need to seed this with sufficient buyers. And we're talking to a number of opportunistic funds who see the value in this. But it requires liquidity. It requires, buy side interest in these tokens. And I think that also occurs once we have scale and a number, dozens and hundreds and thousands of assets on our platforms. So I do think liquidity will happen. It is the number of tokenized projects is growing exponentially, but anyone who says that tomorrow the NASDAQ of real estate is going to happen, I'm a little skeptical. My last thing I'll say before kind of turning to questions is just an ask to the audience. If you're a sponsor developer looking for capital for a project, reach out to us. Reach out to assets.bonfire.capital. If you're an investor looking to expand and diversify your portfolio and actually directly invest in projects, not in a managed pool of, like a REIT, go to our website, sign up for our wait list. We'll be in touch with you. And with that, I will turn it over to questions. First question I see is, yes, we are using an LLC structure. It is a Delaware-based LLC structure. Another question I see is, don't REITs solve the problem you're trying to solve for liquidity and access for everyday investors? And the thing that I would say is that we are focused on folks who historically are not interested in REITs. These are younger investors. The typical millennial is more likely to own crypto than a mutual fund, and they want to own real assets as demonstrated by the rise of NFTs and other their participation in the stock market. And so REITs is an investment in a corporation that owns a bundle of properties. We're facilitating direct ownership. Let's see, are tokens the same thing as cryptocurrencies? No, cryptocurrencies are largely speculative and have little intrinsic value. Our tokens are directly tied to each asset, and they're basically backed, they're asset-backed tokens, if you will.
Hey, Joshua,
yeah.
I would just say that when you're looking at crypto, there's usually nothing behind it, whereas what you're talking about here is the use of blockchain technology to create a token that has a tangible asset tied to it. Whereas if you look at something like Bitcoin, there's no tangible asset tied to it. This actually has this tangible asset, something we're all familiar with, something that everybody uses, which is real estate.
That's a great point, Saul. And to that end, there's a world in the future through some of these, and I don't mean to get too geeky on Web3 stuff, where people could collateralize their tokens and be able to lend against them. I mean, there's a lot of really interesting use cases in the future, to your exact point, Saul, that these tokens have assets behind them, right? They're not just made up out of nowhere. Great point. A question is, what's the difference between one of our tokens and NFTs? Kind of answer that, but NFTs, aren't, well, I guess the technical answer is that our tokens are fungible, meaning that they're exchangeable for one another. If we tokenize a hotel and there's 1,000 tokens representing all the interests in the asset, whether I own a token and Saul owns a token, they confer the same economic rights to that asset. Whereas an NFT is truly non-fungible. It's its own special, unique token that's not like anything anyone else owns. Someone asked, how do we determine which assets or which asset class to tokenize? It's a great question, Michael. Right now we're looking at a bunch of different stuff, and it's really the strength of the sponsor and the type of asset. I'll be the first to admit that we're a relatively young company, and we don't have total clarity of are we just going to do hotel projects or multifamily, et cetera. And so that's but every deal we're looking on the strength of the sponsor and the actual real estate.
Joshua, when you look at real estate and the real estate uses, typically the more intensive the use, the more valuable the real estate is. And so if more people can utilize that piece of real estate, that real estate is more valuable. And typically with more opportunity comes more risk. And so different people might want to invest in shopping center assets or apartment building assets, multifamily, or in single family homes, many different real estate assets, all of which theoretically could be tokenized. And then based on your investment profile, what you're looking for, your tolerance for risk, just like when you go out and buy real estate itself, you would be able to buy real estate that fits your particular real estate need, your tolerance for risk, your risk profile. And so eventually maybe I'm a dreamer, but eventually all types of real estate, and then the consumer, the buyer, will make the decision for themselves which type of real estate they want to invest in. And what this does at this point, we see it opening up categories of real estate that people would not normally be able to invest in unless they had a lot of capital.
Great point, Saul. I'm cognizant we're sort of at the top of the hour. I'll go 5 more minutes and answer questions. I know folks might have to drop off, but I want to be respectful to people's questions. One is, how does crypto play into this? Are you buying tokens with crypto? So people can buy our tokens with cash, credit card, or crypto. I think we support 15, I'd have to ask my co-founder, 15 different cryptocurrencies. Another question is, can you invest in assets from outside the US? Absolutely. Every country has their own jurisdictional challenges or opportunities. So I would, and this is a gentleman or lady named Surya, I'd recommend reaching out to us directly and we can talk about your jurisdiction. Will Bonfire figure out a way to potentially offer monthly cash flow from the assets? Absolutely, Mario. Right now on our first asset, we've been doing distributions quarterly, but there's nothing that would stop us from doing it daily. It's just a matter of transactional costs and things of that nature where, yeah, so we can absolutely do that. How does the current banking issue affect real estate tokenization market? I would say the current banking situation affects real estate in general in a number of different ways. I think that we're going through a bit of a shock right now, and people just don't know what is their money safe in the bank. And I come back to the term in Mandarin Chinese of crisis as a combination of danger plus opportunity. I mean, interest rates already dropped 50, 70 basis points since last Wednesday, right? So real estate's became more affordable in one sense, at least to finance it. But, I think if one has the capital or at least has a thesis and has a level head, that there's going to be phenomenal opportunities during this time of upheaval. But I don't know that banking affects tokenization as separate from how banking will affect real estate. You should do an interactive meetup so that others can share their view. Okay, I would love to do a meetup. What happens if the homeowner moves out? I don't really understand that question. We're focused only on income producing real estate assets. So that's, if a tenant moves out, then another tenant comes in.
A good point here is that there's a structure for the management. We said there's different phases of buying. There's the acquisition phase, the management phase, and the disposition phase. And what Bonfire is doing is created an apparatus so that if the rental property, be it a house or an apartment building, can be managed. And so if the tenant moves out, it's just like in any real estate situation where there would have to be a new tenant found, a new tenant would be put in the property, and that's covered in the management structure in the DAO aspect of this. Got it.
Great point, Saul. Will we be doing this with agricultural land? Chris, what I'd say to that is we're looking at a bunch of different stuff. I mean, I'm reminded that, Amazon only sold books its first 7 years. Like, feels like we need to kind of nail a couple, one use case first, and that's kind of income producing real estate. But, a couple people approach us about agriculture and solar. So happy to chat with you offline. How do you determine the value of a token and the total quantity per asset? It's a great question. The first one, which was $310,000, we arbitrarily made it 10,000 tokens and a price of $31 per token. It's just really a matter of the allocation and how do we make it affordable for people to be able to buy, but also so that we don't have so many buyers, different buyers, that the administrative headache of actually managing K1s and things of that nature isn't overwhelming. And how are we guaranteed an ROI if we don't legally have an owner's interest in the property? So with Bonfire, our model, you actually do have an ownership interest in the property. So we don't guarantee anything. We're not managing these properties per se, so we don't guarantee an ROI. But you have legal, pari passu interests in these assets. And I'm personally investing in these properties. So, we'd be co-investors in these properties. Nelson asks, is this considered crowdfunding? I don't know, Nelson, if you mean in terms of the technical definition of like Reg CF or just in general, like colloquially, but I think, this is people coming together to own assets who might not know each other. that technology is facilitating. So it's a form of crowdfunding, but I think it's more dispersed and international at just kind of different with a focus on real estate. Any other questions, guys, that I'm not addressing? Is Bonfire raising capital? We're not actively raising, Chris, but I'd say is like as CEO, I'm always having to think about where like our long-term capital needs and really finding strategic partners. We're talking to a couple folks about investing in us who would be great strategic partners because they own real estate or they have a lot of knowledge in this space. So that we're pretty open to, but we're not actively raising right now. Thank you for that question. How will Bonfire update members in reference to valuation changes? Great question, Mario. We are going to be doing quarterly updates until we have, we will be doing quarterly updates on every asset going forward. But once we have the secondary marketplace built, in somewhere between 3 to 9 month range, the valuations, we're going to have things like desktop appraisals and other things that people have access to that will be embedded in the smart contracts of the tokens. Let me see if there's any other questions. One question is, how is Bonfire different than Fundrise? Fundrise, there's a lot of sites like them where they enable you to have access to, I don't know, multifamily in the Southeast or office sector of the Northeast. And they're basically kind of like a private REIT. We're not that. We are facilitating direct investments into real estate. And that's pretty much, I think, every question. Saul, anything you want to add or any questions that come to mind for you?
No, I think it's leading edge, and what we're talking about is giving everybody an opportunity to invest in an asset that is difficult sometimes for people to invest in. And so for that in itself, you mentioned the democratization of owning real estate. This is just a huge plus and a huge opportunity for people to be able to build wealth. And we're still, as you say, in the top of the first inning, right? It's still early.
Awesome. Well said. Completely agree with you. I want to be respectful of people's time. I know we've kind of gone over. There'll be a recording of this webinar shared with folks. But if you have any questions for either Saul or I, you can see our emails. Please feel free to reach out to us. And really appreciate everyone's time. Thank you.
Thank you.